There's an interesting story that started catching the attention of some fund managers in New York over the past few years. At one point, they noticed something pretty unusual happening in the market. The S&P 500 was rising, indexes were hitting new highs, and sentiment looked pretty positive. But when they looked deeper, they discovered that most companies inside the index were not rising along with it. When these managers began conducting a structural analysis of the S&P 500, they realized something that few investors truly notice. The most famous index in the world may not be as diversified as it appears, and understanding this can completely change how you interpret the market in 2026. If you haven't seen me here before, I'm Chad, and here on the Zero Markets channel, our main goal is to bring you the financial market insights to help you become a more critical and strategic investor. If you invest in ETFs, US stocks, or any type of global portfolio, there's a good chance you have some exposure to the S&P 500. After all, it represents about 80% of the total value of the US stock market, and for decades, it has been considered one of the simplest and most efficient ways to invest in the American economy. But there's an important detail that has changed significantly in recent years. The structure of the index has been quietly transforming, and understanding this shift is now essential for anyone who wants a deeper view of the market. In this video, we're going to conduct a structural analysis of the S&P 500 to understand what is really supporting the US markets in 2026 and why this could directly impact how investors think about risk, diversification, and long-term growth. Let's imagine an investor named Mark back in 2020. He made a decision many experts would consider extremely rational, investing in an ETF that tracks the S&P 500. And the logic seemed pretty simple. By investing in the index, he would automatically gain exposure to 500 of the largest companies in the United States, spread across different sections of the economy. And for a while, everything seemed to work perfectly. The market went up, the portfolio grew, and Mark believed he was protected by a diversified strategy. But a few years later, when he decided to look more closely at the index data, he noticed something curious. Despite being invested in hundreds of companies, a large portion of the investment performance was being driven by a very small group of companies. This is exactly the central point of any structural analysis of the S&P 500 today. When we examine the weight of the companies inside the index, we discover something that surprises many investors. Currently, the 10 largest companies in the S&P 500 represent roughly 35 to 40% of the entire index, and this includes companies like Apple, Microsoft, NVIDIA, Amazon, Alphabet, Meta. In practice, this means the behavior of the index is becoming increasingly dependent on these mega cap companies. This small group rises, the index rises with it, even if many other companies within the S&P 500 are struggling. The growing concentration is one of the most important points in the structural analysis of the S&P 500 in 2026 because it completely changes the perception of risk and diversification that many investors believe they have. Part of this structural shift is directly linked to the technological transformation we're living through. In recent years, AI has begun playing a central role in the global economy, and some companies have positioned themselves as key players in this new digital infrastructure. NVIDIA is probably the most emblematic example of this. In just a few years, that company moved from a market value of around $300 billion to more than $2 trillion, driven by massive demand for chips used in data centers and AI systems. This type of growth not only boosts the value of these companies, but it also changes the behavior of the index itself. The S&P 500, which once reflected different sectors of the economy in a more balanced way, is now far more sensitive to the performance of large technology companies. This is another essential aspect of the structural analysis of the S&P 500 that many investors are starting to watch much more closely. There's also an indicator that institutional managers tend to follow very closely to understand the real health of the market. This indicator is called the market breadth. It basically measures how many companies are rising or falling within an index. And in several recent moments in the market, something very unusual happened. While the S&P 500 was posting a lot of gains and appearing strong at the first glance, more than half of the companies inside the index were actually declining. This creates an important divergence. The index continues to rise, but fewer and fewer companies are participating in that movement. Historically, this type of behavior has appeared during specific moments in the market and often sparks important debates among institutional investors about the sustainability of that trend. Now, interestingly, something similar happened before. In the late 1990s, 90s, during the peak of the internet bubble, a small number of technology companies began dominating the market. I remember this. This was very significant. The excitement was enormous and growth seemed limitless, and many investors believed they were living through a new economic era, myself included. The NASDAQ rose dramatically during that period, but when the bubble finally burst in the early 2000s, the index eventually accumulated a decline of nearly 78% over the following years. That doesn't mean the same thing's going to happen now, but it serves as an important reminder of why understanding the structure behind the market is so relevant. The structural analysis of the S&P 500 exists precisely to look beyond the surface numbers and understand how risk is actually distributed within the index. The S&P 500 remains one of the most important indicators of global economy and over the decades has proven to be extremely resilient. However, the reality of the market in 2026 shows that the internal dynamics of the index have changed very significantly. Today, much of the movement in the U.S. market is concentrated in a handful of giant technology companies, many of them directly linked to artificial intelligence revolution. This does not necessarily make the index more fragile. It certainly makes its structure different from what many investors imagine. And that's why more and more professional investors are no longer looking only at index chart. Instead, they're examining how the index is built internally. Because in the end, the most important question is not simply whether the market's going up or down. The real question is who's driving the market. And that is exactly what a solid structural analysis of the S&P 500 aims to reveal. If you want to understand the market beyond the headlines and the most obvious charts, follow Zero Market. The goal here is not just to show what's happening in the market, but is to explain why these changes are happening and what they truly mean for investors.